Mr. AG here. Silver just gave us one of the wildest 48-hour swings I've seen in months. We went from $83.18 on Wednesday to $84.52 on Thursday morning. That's a 1.62% jump. Then, within hours, spot silver crashed 2% to $81.78, a $3 swing in less than 2 days. And while all of this was happening, a major Chinese silver futures fund got suspended from trading because its premium over net asset value got so extreme that regulators had to step in. This is not normal market behavior. Something is happening beneath the surface. And today I'm going to break down exactly what it is, what it means for silver prices, and what you need to watch in the coming days. But first, I need to hear from you. Where are you watching from right now? Drop your location in the comments. United States, Canada, Australia, United Kingdom, India, Malaysia, Singapore, Philippines, Japan, Hong Kong. I want to know where this community is spread across the globe. Type Mr. AG and your country in the comments. Let's see how international this audience really is. And while you're at it, tell me your current silver position. Are you long? Are you short? Are you waiting on the sidelines? I read every single comment and it helps me understand what this community cares about most. Now, let me tell you what's actually happening because the headlines are not giving you the full story. Silver traded at $84.52 per troy ounce on Thursday, according to FX Street data. That was up 1.62% from the $83.18 it cost on Wednesday. Sounds bullish, right? Sounds like silver is recovering from recent weakness. But then just hours later, spot silver dropped 2% to $81.78 per ounce. That's a significant reversal. That's the kind of volatility that shakes out weak hands and confuses retail traders who don't understand what's driving these moves. The year-to-date performance tells a more constructive story. Silver prices have increased by 18.91% since the beginning of the year. Think about that for a moment. Despite all the volatility, despite the crashes, despite the margin hikes, despite everything the market has thrown at silver holders, we're still up almost 19% on the year. That's not nothing. That's significant outperformance compared to most asset classes. But the path has been anything but smooth. The gold-silver ratio stood at 61.28 on Thursday, down from 61.73 on Wednesday. Now, I know some of you newer viewers might not understand why this ratio matters. Let me explain, because this is one of the most important indicators I watch for precious metals positioning. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Historically, when the ratio breaks below 55, silver tends to outperform gold significantly. When the ratio rises above 65, it often signals that silver is about to underperform, or that the broader precious metals complex is weakening. Right now at 61.28, we're in neutral territory, but the direction matters. We went from 61.73 to 61.28. That's the ratio declining. That's silver gaining ground relative to gold. That's typically a bullish signal for silver in the medium term. Now let's talk about what happened in China, because this is the news that most Western analysts are completely ignoring. Guotai UBS Fund Management Company announced that their Silver Futures Securities Investment Fund, the LOF A-Class Fund shares, was trading at a significant premium in the secondary market compared to the net asset value. This premium got so extreme that the fund management company had to take action. They announced a trading suspension from market opening until 10:30 on March 6, 2026. Redemption operations would continue as usual during the suspension period. And here's the critical part. If the premium does not effectively decrease on March 6th, the fund reserves the right to apply for an intraday temporary suspension or extend the suspension period through the Shenzhen Stock Exchange. Let me break down what this actually means, because the implications are significant. When a fund trades at a premium to its net asset value, it means investors are paying more for the fund shares than the underlying assets are actually worth. Why would they do that? Because they can't get enough silver exposure through other means. Because physical silver is difficult to source. Because other investment vehicles are restricted or unavailable. When the premium gets extreme, it tells you that demand for silver exposure is overwhelming the available supply of investment products. This is happening in China, the world's largest consumer of silver, the country that implemented export controls on refined silver on January 1st, the nation that is strategically stockpiling critical minerals. Chinese investors are so desperate for silver exposure that they're paying significant premiums above net asset value just to get into a silver futures fund. And the premium got so extreme that regulators had to suspend trading to protect investors from themselves. Think about what this signal means for the broader silver market. If Chinese investors are paying premiums to get silver exposure through funds, imagine what they're paying for physical metal. Imagine what industrial users are paying to secure supply for their manufacturing operations. The premium situation in Chinese funds is a window into the physical tightness that exists in the actual silver market. Quick pause here. Before I continue, I want to make something very clear. I don't sell courses. I don't sell memberships. I don't sell signals. I don't sell anything. Everything I share on this channel is completely free because I believe everyone should have access to real market analysis without having to pay for it. If you're finding value in this content, the best way to support me is to subscribe, hit the notification bell, and share this video with someone who needs to see it. That's how we grow this community together. And speaking of community, make sure you join our WhatsApp group. The link is in the description below. We share real-time updates, discuss market moves as they happen, and help each other navigate this crazy market. Also follow me on X, formerly Twitter. My handle is Mr. Gasian Guy. That's the only official account. If anyone else reaches out claiming to be me, asking for money or offering investment advice, block them immediately. I will never do that. I will. Protect yourself out there. Now let's get back to the price action because the volatility we're seeing is telling us something important. Silver going from $83 to $84.50 to $81.78 in less than 48 hours is not random noise. This is a market under stress. This is a market where paper prices are being pulled in multiple directions by competing forces. On one side, you have physical demand, Shanghai premiums, Chinese fund premiums, industrial stockpiling, central bank accumulation, investor demand for hard assets. These forces want silver higher. They represent real demand for actual metal. On the other side, you have paper market dynamics, margin requirements, leveraged positioning, algorithmic trading, bullion bank interventions, dollar strength. These forces can push paper prices lower even when physical demand is strong. They represent financial engineering rather than actual supply and demand. When these two forces collide, you get exactly the kind of volatility we're seeing. Sharp rallies followed by sharp reversals, moves that don't make sense based on fundamentals alone, price action that frustrates both bulls and bears. This is what a market in transition looks like. The paper and physical markets are diverging, and at some point they will have to reconcile. Let me ask you a question. What do you think silver will be trading at by the end of March? Higher than current levels? Lower, about the same? Drop your price prediction in the comments along with your location. I'm curious what the collective wisdom of this community suggests. And don't just give me a number. Tell me why. What's your reasoning? What are you watching that informs your view? Let's have a real discussion. Now, I want to walk you through both scenarios for the coming weeks because I believe in showing you both sides of every trade. I'm not here to pump your bags. I'm not here to spread fear. I'm here to give you the information you need to make your own decisions. So let's do the bull case and the bear case. Bearish scenario first. The recent volatility continues as leveraged longs get flushed out. Silver breaks below $80 and tests the $75 support zone. Dollar strength persists as the Federal Reserve maintains hawkish rhetoric. The Chinese fund suspension creates negative sentiment that spreads to other silver investment products. Premiums in Chinese markets start to narrow as demand cools. The gold-silver ratio rises back above 65, signaling silver underperformance ahead. Industrial demand moderates as economic growth concerns intensify. COMEX registered inventory stabilizes or even increases, slightly reducing squeeze pressure. Margin hikes continue, forcing more position liquidation. Safe haven flows go to bonds instead of precious metals as treasury yields remain attractive. Bitcoin and risk assets continue struggling, which creates broader risk-off sentiment that hurts all commodities. Silver consolidates in the $70 to $80 range for an extended period. Paper market maintains control. Bulls get exhausted. This is the bearish scenario. It's absolutely possible, and you need to be prepared for it. Bullish scenario. The Chinese fund premium situation is just the tip of the iceberg. More funds and investment products start trading at premiums as silver exposure becomes scarce. Physical demand overwhelms paper supply. Shanghai premiums expand further, drawing more metal east. COMEX registered inventory continues declining toward critically low levels. The gold-silver ratio breaks below 55, signaling aggressive silver outperformance ahead. Industrial users panic buy to secure supply for critical applications. Solar panel manufacturers, electronics companies, medical device makers, all scrambling for metal. Central bank buying accelerates especially from Asian nations seeking to diversify away from dollar assets. The dollar weakens as geopolitical tensions and fiscal concerns mount. Safe haven flows return to precious metals as bond market credibility is questioned. Silver breaks back above $90 and targets the January highs above $115. The year-to-date gain of 19% expands to 50% or more. Physical reality overwhelms paper manipulation. Silver enters a new bull phase. This is the bullish scenario. It's also possible, and you need to be prepared for it. The honest truth is nobody knows which scenario plays out. Anyone who tells you they know for certain what silver will do next week or next month is either lying or delusional. What we can do is identify the key variables, watch them closely, and adjust our positioning as the situation evolves. That's how you navigate uncertainty, not by pretending you can predict the future, by being prepared for multiple outcomes. Here's what I'm watching this week. Number 1, the Chinese fund premium situation. Does the premium decrease when trading resumes, or does it remain elevated or even increase? If premiums stay elevated despite the suspension, that's extremely bullish for the physical scarcity thesis. Number 2, the gold-silver ratio. Does it continue declining toward 55, or does it reverse higher toward 65? The direction of this ratio in the coming days will tell us a lot about relative momentum between the two metals. Number 3, silver's ability to hold above $80. That's a key psychological level. A sustained close below 80 would be technically bearish. Holding above 80 despite volatility would be constructive. Number 4, COMEX inventory data. Registered inventory levels specifically. Any significant changes up or down will inform the delivery squeeze narrative. Number 5, dollar index behavior. The dollar has been strong recently, which pressures commodity prices. Any reversal in dollar strength would provide tailwind for silver. Now let me give you some perspective on where we are in the bigger picture because it's easy to get lost in daily price swings. Silver is up 18.91% year to date. That's after starting the year around $70 and running all the way to $115 before correcting. We've had a 40% plus correction from the highs. That's painful if you bought the top. But corrections of this magnitude are completely normal in bull markets. They shake out weak hands. They reset sentiment from euphoric to cautious. They create the conditions for the next leg higher. Look at any major bull market in history. Gold in the 2000s, Bitcoin in multiple cycles, Tesla stock, Amazon stock. The biggest winners always have massive corrections along the way. 50% drawdowns are not uncommon. 60% drawdowns happen. The question is not whether you can avoid the corrections. The question is whether you have the conviction and position sizing to hold through them. If you're over-leveraged, these corrections will destroy you. Margin calls don't care about your long-term thesis. They don't care about physical scarcity or industrial demand or Chinese fund premiums. They just force you to sell at the worst possible time. This is why position sizing matters more than being right about direction. You can be completely right about silver going higher over the next few years and still lose money if you're too leveraged and get stopped out during a correction. I want to talk to the newer members of this community for a moment. If you just found this channel, welcome. But I need to be straight with you. This market can and will hurt you if you don't know what you're doing. The volatility is extreme. The swings are violent. The information environment is noisy and confusing. You will see silver up 2% in the morning and down 2% in the afternoon. You will see headlines that make you want to buy everything and headlines that make you want to sell everything. You will feel fear and greed pulling you in different directions. The only way to survive and thrive in this environment is to have a plan before you enter any position. Know why you're buying, know at what price you would sell if you're wrong, know how much you can afford to lose, know your time horizon. Are you trading for the next week or investing for the next decade? These require completely different approaches and completely different position sizes. Do your own due diligence. Don't take my word for anything. Verify the data yourself. Understand the risks. Be accountable for your own decisions. Don't blame anyone else if things don't go your way. This is your money. This is your responsibility. I'm just here to share analysis and perspective. The decisions are yours alone. Now, about 65% of you watching right now aren't subscribed. I know this because I checked the analytics. I'm not trying to guilt you into subscribing. I'm just saying that if this content is helping you, subscribing helps me keep making it. I don't monetize this channel aggressively. I don't have annoying mid-roll ads. I don't have sponsors telling me what to say. I just share my genuine analysis and let the chips fall where they may. If you appreciate that approach, subscribe. If it's not for you, no hard feelings. Let me connect today's developments to the bigger structural picture, because the day-to-day moves only make sense in context. We are in the middle of a generational shift in how precious metals are priced and traded. Western exchanges like COMEX have dominated price discovery for decades, but that dominance is eroding. China is building alternative infrastructure. Shanghai Gold Exchange, Hong Kong Precious Metals Clearing, direct deals between miners and industrial users that bypass exchanges entirely. Chinese investment products like the fund that just got suspended are channeling massive demand from Chinese investors who want silver exposure. Export controls are severing traditional arbitrage routes. Shanghai and New York are becoming separate markets with separate prices. This divergence cannot persist indefinitely. Either Western prices rise to match Eastern prices, or the Western pricing mechanism loses relevance entirely. There's no stable equilibrium where physical metal trades at 10 to 15% premiums in Asia forever while paper prices in New York stay suppressed. One market will overwhelm the other. History suggests it will be physical that wins. The Chinese fund suspension is another data point in this structural shift. Chinese investors want silver so badly they're paying premiums above net asset value. Regulators have to suspend trading to prevent investors from overpaying even more. This is not a sign of a market imbalance. This is a sign of a market desperate for exposure to an asset that is becoming increasingly difficult to access. Now, I want to address the price action specifically because I know many of you are trying to trade these swings. Let me give you the key levels I'm watching. Immediate resistance is at $84.50. That's the Thursday high before the reversal. Any rally needs to reclaim and hold above this level to suggest the correction is complete. Stronger resistance sits at $86. This is where prior rallies have stalled. Breaking above 86 with conviction would open the door to $90. Major resistance is the January high at $115.08. That's the target for the bull case. Getting there would require a 40% rally from current levels. Absolutely achievable in this environment, but not without significant volatility along the way. On the downside, immediate support is at $81.78. That's the recent low after the Thursday reversal. If this breaks, the next support zone is $80 psychological level. Deeper support sits at $75. This aligns with prior consolidation zones and would represent a 50% retracement of the entire move from $29 to $115. A move to $75 would be painful, but would not invalidate the longer-term bull thesis. Critical support is at $70.56. That's the 2026 low from early January. A break below this level would be technically very bearish and would suggest the correction has more room to run. The trend line from the April 2025 lows around $29 remains intact as long as we stay above roughly $65. That's the level where the entire bull market thesis would be seriously questioned. As long as we're above that trend line, corrections are opportunities, not exits. Let me ask another engagement question. What's your average cost basis on silver if you hold any? Are you in profit at current levels? Are you underwater? Or are you waiting for a better entry? Drop your answer in the comments. It helps me understand where this community is positioned and what kind of content would be most useful. Now I want to talk about the gold-silver ratio in more detail because this indicator has been my friend for many years. At 61.28 currently, we're in what I call the neutral zone. Not screaming buy silver, not screaming avoid silver, just waiting for a clearer signal. Here's how I use this ratio. When it breaks below 55, that's when I get aggressive on silver positioning. History shows that ratio breakdowns below 55 often precede significant silver outperformance. The ratio got as low as 30 during some of the most explosive silver rallies in history. When the ratio rises above 65, that's when I get cautious on silver specifically and consider rotating toward gold or reducing precious metals exposure altogether. High ratios often precede periods of consolidation or correction in the silver market. Between 55 and 65, I maintain my existing positions, but don't add aggressively in either direction. I let the market show me which way it wants to resolve. Currently at 61, trending down from 61.73, the ratio is telling me to be patient, but constructive. The declining ratio suggests silver is gaining relative strength. But we haven't broken the key 55 level yet that would trigger more aggressive positioning. This is the kind of nuanced analysis you won't get from the mainstream financial media. They'll tell you silver was up today or silver was down today. They won't tell you what the gold-silver ratio is doing and why it matters. They won't connect the Chinese fund suspension to the broader physical scarcity narrative. They won't explain how paper and physical markets are diverging. That's the value I try to provide here. Context, framework, analysis that helps you make better decisions. As we approach the end of this video, let me summarize the key points because we've covered a lot of ground. Point 1. Silver experienced extreme volatility, moving from $83 to $84.50 to $81.78 within 48 hours. This volatility reflects competing forces between physical demand and paper market dynamics. Expect continued swings in the near term. Point 2. A major Chinese silver futures fund was suspended from trading due to extreme premium over net asset value. This signals that Chinese investors are desperate for silver exposure and willing to pay above fair value to get it. This is a bullish indicator for physical demand. Point 3. The gold-silver ratio declined to 61.28 from 61.73. This declining ratio suggests silver is gaining relative strength versus gold. Watch for a break below 55 for a major bullish signal or a rise above 65 for a cautionary signal. Point 4. Silver is up 18.91% year-to-date despite the recent correction. The longer-term trend remains constructive. Corrections of this magnitude are normal in bull markets and create opportunities for patient investors. Point 5. Both bullish and bearish scenarios are possible from here. Dollar strength, leverage unwinding, and risk-off sentiment could push silver lower. Physical demand, Chinese premiums, and supply scarcity could push silver higher. Position sizing and risk management are essential in this environment. Point 6. Key technical levels to watch are 84.50 resistance, 86 stronger resistance, 81.78 immediate support, 80 psychological support, and 75 deeper support. Trade accordingly. The unresolved tension is this. Paper markets are showing weakness with volatile swings and position liquidation. Physical markets are showing strength with premiums, fund suspensions, and persistent demand. At some point, these two realities will reconcile. Either physical demand fades and paper prices stabilize lower, or physical demand overwhelms paper supply and prices reset dramatically higher. The volatility we're seeing is the market trying to figure out which outcome prevails. I don't know which scenario plays out next week, but I know what levels to watch. I know what indicators matter. I know how to adjust as new information emerges. That's the edge in this market, not predicting the future, managing uncertainty with a clear framework. Before I sign off, drop one more comment for me. What's the most important thing you want me to cover in the next video? Silver technicals, gold analysis, mining stocks, Chinese market developments, COMEX delivery data? Let me know what matters most to you. This channel exists to serve this community, and I want to make content that helps you most. Make sure you join our WhatsApp community. Link is in the description. Follow me on X at Mr. Gasian Guy. That's where I share real-time updates that don't always make it into videos. Remember, invest with logic, not emotion. Have a plan. Stick to your plan. Don't let volatility shake you out of good positions. Don't let greed push you into bad positions. Use your brain. Do your own research. Be accountable for your own decisions. The silver market is volatile, confusing, and sometimes frustrating, but it's also full of opportunity for those who understand what's happening and position appropriately. Stay informed, stay disciplined, stay patient. Mr. AG out. Talk to you soon.